Hi everybody and welcome to the London session update on Monday the 23rd of September 2013. Well, it could be called Merkel Day. She did very well in those German elections. It was outstanding actually. It was the strongest number of votes for her CDU party for over 20 years, and she really joins a very elite parthenon of only a handful of chancellors who've been elected for a third term. So what is a personal victory for Merkel wasn't so fantastic from a government perspective because she didn't quite win enough to form a government. Coalition politics, they're very traditional, very normal in Germany. So that's not the shock. But what was shocking was the FDP's very bad result. Now this was a junior coalition party. It's considered as a pro-business liberal party. It didn't quite get the 5% needed, which now means that Merkel will have to go into horse trading with some of the other parties. There's the Greens on one side, pretty leftist, very different policies, both social, energy policies from the CDU or the Christian Democrat bloc of parties, which Merkel is heading up. And then you also have the Social Democrats. So that's the arch rival, if you like, of Merkel. They got about 23% or 26% in the poll, and they could be they could form a coalition, or Merkel could form a coalition with them, which would be known as a grand coalition. That would be slightly more problematic. Obviously, they are rivals. It could be a bit treacherous having them in coalition, and a grand coalition actually did collapse back in 2009. So overall, the market reaction has been fairly muted, but because there's been so much support for Merkel, it suggests more of the same. I don't think that any of the coalition partners are going to do anything to rock the boat, and that is really being reflected in the markets today. So let's take a look at the bond markets, where we really are seeing absolute stability post this Merkel election. And remember, the German elections were considered one of the key hurdles for the Eurozone crisis, which the outcome of which could have had big impact. Well, now that tail risk of the German election has been eliminated, and it does seem like the problems in the Eurozone, even though they're on the horizon, they're not a problem for today. So things like Germany needing a second, or Greece, sorry, needing a second bailout, maybe they're not impacting the data today or the there. This chart deals, German bond deals, as you can see, to trade just in a very stable fashion, continue to reflect the stronger tone to economic data in the Eurozone. That's why they're slightly higher than the periphery, even though not just on a normalised basis. So even though Spanish and Italian bond yields are higher than Germany's, they have actually been growing at a slightly lower pace as sovereign fears have actually subsided. So that's what we're seeing here. When German yields are increasing at a faster pace relative to Italian and Spanish ones, that suggests that the market is in a more normal situation. In Germany, maybe Spain, the fears about Spain and Italy and the periphery have just been put to bed. Now, what does this all mean for the euro? Well, overall, as you can see here, it's the euro dollar, it's a daily chart. We haven't done much at all. Now, we have backed away from those 133.50 to 60 highs that we saw post the German election results, immediately post the German election results, and also post that FOMC meeting. We have backed back towards 135, and we think that any move back towards 134.80 could just be picked up on the dip. So overall, very muted reaction in the euro, but it could start to play catch up. Right now, we think we're stuck in range bounding territory. There's not too much data out now for the next couple of days, and that could really keep us quite stable. So we think there could be some buying interest on any of those dips below 135, and euro dollar may play catch up because that win for Merkel is probably mildly euro positive at this stage. Okay, everyone, thanks so much for joining. Please do join us next time for more. Bye bye.